This episode of the Big5D podcast is brought to you by Matchcraft, a global ad tech platform managing digital marketing campaigns for partners around the globe. Its latest initiative is Powered By. This utilizes Matchcraft's suite of APIs, allowing third-party platforms to gain access to the technology used by its flagship Advantage platform. This powers search, social, and display campaigns for local businesses around the globe. Visit them at matchcraft.com for details. That's matchcraft.com. Hey everyone, and welcome to the Big5D podcast. I'm Charles Laughlin, and I'm content director for Big5 Digital. So we've taken a bit of a hiatus from the podcast over the past couple of months, but today we're back with a great one. We've got Zach George, who's managing partner for Launch Africa Ventures. This is an African venture firm investing in early stage African tech companies across a variety of sectors. That includes fintech, health tech, logistics, ed tech, and a bunch more. Some of the firm's more prominent investments, some companies you may have heard of, include Kune, WorkPay, PayHippo, MarketForce, Zindi, and many, many more. A lot of really exciting companies across the African continent that they've made early stage investments in, and Zach is the leader of that initiative. So as with any venture firm, they've also had a few misses, and one of them is Kune Food, which we've written about extensively at the SMME Tech Report, which is our companion newsletter to this podcast. And that's a Kenyan food tech firm that ceased operation early this year after kind of a tumultuous one-year tenure. We don't really talk about this on the podcast because Zach and I actually had a long conversation about it when the company shut down, which I included in the write-up I did in the newsletter. So if you want to learn about that story, go back to the newsletter. We kind of talk about more forward-looking things on the podcast. Anyway, so please check out our newsletter and please subscribe. As far as this conversation goes, we talked to Zach about everything, kind of from his background, what led him into venture capital. And we really spent a lot of time talking about the current market conditions in venture funding for tech startups in Africa. And they're specifically focused on B2B, which Big5 Digital also is focused on B2B. So we really drilled down on that and what the conditions are in the market for that. Talked about, how startups should be adapting to the current environment, kind of what his investment thesis is, what he likes to invest in, what sectors he's excited about, and so on. So it's a really great interview. I think it's one of the best ones we've done in a while. And so I'm excited to share it with you. Before we get into it, I want to talk a little bit about what we've got coming up with Big5 Digital. We have announced our dates for the Big5 Digital Summit, our Big5 Summit for 2023, which takes place in Cape Town, March 14th through 16th at the Radisson Blu Waterfront. So please diarize those dates, and we'll have a lot of announcements coming up soon regarding speakers and sponsors and so on. But if you're interested in getting involved with this event, whether as a speaker or a sponsor, both, or just interested in learning more about it, feel free to write to me. Just write to us at info@big5digital.org. That's big5digital.org. And tell us what you want to talk about regarding the event, and we'll get back to you. We want it to be very inclusive. We want early stage companies. We want corporates. We want companies in between. We want investors. We want some SMMEs to speak to us directly. The event is actually not specifically for SMMEs. It's more for the ecosystem supporting small business, but small business are a welcome addition to the event as well. So please reach out to us to talk to us about the Big5 Summit. We're very excited to get you involved. Let's move on to our interview with Zach. And thanks for joining us. And thanks for supporting us. Here we go. Zach, welcome to the podcast.
Thank you. Thank you, Charles. Good to be here.
Yeah, it's great to have you. So Launch Africa Ventures, I think a lot of folks who listen to us are familiar with you guys and familiar with you. But just if you could do two things very quickly before we dig into some topics. One, a little bit about your background, kind of where you came from and what led you into the venture world. And then quickly on, after that, quickly on your firm and what its basic
raison d'etre is, that sort of thing.
Yeah, sure. Yeah, quite a few folks here may know a bit about my background. I've done quite a few of these in the past, but just to sort of recap, I spent most of my career in investment banking. I used to work on Wall Street for two big firms, Lehman Brothers and Barclays. Got my master's from Stanford about 16, 17 years ago, and moved to South Africa from New York City in 2010, almost on a complete coincidence, to watch the World Cup in 2010, the soccer World Cup.
Just never left.
yeah, it was quite something. It was a 5-week holiday or 5 to 6 week holiday that turned into a 12-year holiday.
Okay.
But the reality was, in 2010, outside of the World Cup being in South Africa, there was also very little focus on entrepreneurship, venture, or anything tech or tech related. South Africa and the African continent as a whole was pretty much looked at as a store of value from minerals, mining, manufacturing.
Right.
It was raw materials, right? There was very little side of it was oil and gas, power, energy, minerals. That was about it. African private equity was probably about 10 to 15 years old in that respect, but venture capital as an asset class just did not exist. So in 2010, when I moved here, I decided that there was, I'm pretty entrepreneurial in the way I think, and I decided that I would explore that itch further. So I spent the next 3 to 4 years working as a consultant to large telcos, banks, and insurers, helping them better appreciate the innovation coming out of SMEs. I wouldn't even call them startups at the time. SMEs have very different characteristics to startups. But and after doing that for a few years, I set up the first venture building studio, which became the first accelerator in Africa. It was called Barclays Rise, which morphed into Techstars in 2016. But in 2015, we ran the first accelerator in Africa. And it was the first time that fintechs on the African continent could find, call it a sponsor bank. At the time, Barclays, which used to own 60% of ABSA. And it was the first time that you saw the proliferation of POCs, pilots, and commercial agreements between a large financial institution and a whole bunch of fintechs. That went on really well. In 2017, we launched Startup Bootcamp, which is one of the world's largest accelerators for B2B startups. They've got a huge presence in Europe and Asia. And then myself and my co-founder, Philip, we launched Startup Bootcamp in Africa. It was a pretty tough task. So we ran 3 cohorts over 3 years, 2017 to 2019. We looked at more than 4,000 startups, and we picked 30, so 10 a cohort over 3 years. Several of those companies are now worth significant amounts of money. The biggest success story is a bank called Kune Bank, the largest digital bank, challenger / neobank in Africa. Several fintechs that are now doing exceptionally well: Akiba Digital, Rentosa, Curacao. But essentially, it was the first time that corporate Africa, represented by telcos, banks, retailers, and insurance companies, went through a structured program where they worked in a non-competitive manner with startups all across Africa. And that was beautiful to see and watch in real time. That accelerator currently has an IRR of north of 100%, which is pretty crazy. But given, that's the benefit of building companies from scratch through an incubator or an accelerator, is you get to get in at very attractive valuations. Right. And the moment companies, start to generate $50,000 to $100,000 in monthly revenue and are doing the Series A and Series B rounds, you're making a huge return because of the valuation arbitrage. Right. And then just over 2 years ago, I launched a fund which is now probably the most prolific and active venture capital fund on the whole of Africa. It's called Launch Africa. We specialize in pre-seed, seed, and pre-Series A investments. So typical, check sizes of up to $300,000, but valuations ranging roughly between $1 million to $10 million. Right. And companies are doing between $25,000 and $50,000 in revenue, but across multiple sectors. But they have to be tech or tech enabled, and they have to have a B2B or a B2B2C business model. And we've now, as of the last 2 years since we started, we've done almost 120 deals across 20 different African countries. So we're by far the most active early stage VC fund on the continent, and we're busy prepping for the launch of our second fund early next year.
Right now, I've reviewed your portfolio. There's a lot of names I'm familiar with. I think a lot of names that are pretty well known. But could you? I know you never want to favor one child over the other, but what would you say are some of the big successes that came out of Launch Africa? What that people may know that you would highlight as some of your bigger stars?
Yeah, I mean, we've had. I mean, the good thing about our fund is, it's a very diverse fund. We do multiple sectors, multiple products, and it's although it is very hard to pick winners. I mean, or rather choose between your children, for lack of a better word. We do look for companies that are able to expand into multiple markets. Within
geographic markets or
geographically within 12 to 18 months of our investment. So if we're backing you at your seed round and you're doing a Series A within 18 months, and if you're, let's say, in Uganda when we backed you and that was your core market, we'd expect you to be in at least a couple of other East African countries or comparable countries within 12 to 18 months of our investment. Because the reality is, scaling a startup is very different from scaling an SME. Most businesses that we back have a subscription revenue model, a software as a service model, or a transaction revenue model. So you don't typically need, the concept of borders as a boundary to your scaling is not really a tech thing. Especially if you're solving a problem for an end consumer, but using a corporate as a distribution channel. So, I mean, this, if you're if you're a video streaming company or you're an e-commerce company, it doesn't matter if you're selling in Uganda, Rwanda, or South Africa. Right. A customer wants something, you got a piece of tech that can solve that problem. Boundaries are political. Right. Tech scales beyond that, right? So the only exception we make is unless your initial home market is a country like Nigeria or Egypt, where you have 200 and 100 million people plus respectively. Anywhere else, you really need to be in multiple markets, right? So some of our top portfolio companies have a dominating position in a big market in Africa. So for example, one of our top portfolio companies is a company called AfriX, AFRIEX. They went through Y Combinator in 2020, and then we backed them right after YC. They do remittances between Nigeria and Ghana, and the US and the UK and now parts of Europe, but they use stable coins, USDT and USDC. They transact, between $7 and $10 million every month, and they make a pretty nice transaction fee. And it solves a real problem, of financial inclusion. The one thing I'll say about investing in early stage African technology ventures is you will never be in a situation, if you invest wisely, where you're putting money to work into problems that don't exist, right? So I call them need to have versus nice to have. Like, no one's here funding, drones that deliver smoothies to high-rise buildings, or like,
that sounds really cool, but yeah, probably not.
Yeah, it sounds pretty cool in San Francisco, but certainly not in Lagos, right? So I'd rather invest in companies that that use drones to deliver ARVs to parts of the continent that can't be reached via cars, buses, trains, and flights, right? So you're solving real world problems with tech, which is an effective substitute for aid and foundation money, which has plagued the continent for the last century almost, or at least post the end of colonialism in the 60s.
Mm-hmm.
So some of the companies, Africa is one of them, it's remittances. Another one is, transportation. So, we've backed a very prominent super app in Francophone West Africa. They're called GoZem, Gozem.
Right, I'm familiar with them, yeah.
Yeah, they're very similar to Grab and Gojek in Indonesia, but they operate in Francophone Africa. They're the market leader. So we backed them at seed, we backed them at Series A, and they're now at Series B, and they're doing exceptionally well. We've got so many companies that I can speak of.
Yeah. Let me ask a question. I was going to ask sort of how important is impact in your decision to back a company, but you kind of answered it a moment ago when you said that it's sort of de facto, right? It kind of most of
yeah.
I'm
not the right person to be going off on a tangent about how important impact is, because there's this concept called what's the technical word for it? I think it's called impact washing, or
I get
washing or something.
Like greenwashing, but the
greenwashing.
Same. Yeah.
Honestly, if you're using tech to solve problems in education, healthcare, agriculture, food and water security, or transportation, you're going to create impact irrespective of you calling yourself an impact fund. So if you look at we've invested in almost 120 companies. The vast majority of those companies, when we backed them, had less than 10 employees. The vast majority. The average number of jobs amongst our portfolio companies right now is north of 30, right? Averages. Obviously lots of extremes, right? Kune Bank has hundreds of employees as an example. Right? So, and then you mustn't always also forget the indirect jobs. So, I mentioned GoZem earlier. Right, GoZem is a super app that does ride-hailing, e-commerce, food delivery, and has its own wallet. But thanks to GoZem, there are tens of thousands of drivers that aren't employed by GoZem but work with them as partners. And if the moment you start adding all of that up, that's massive impact. And GoZem does not claim to be a certain enterprise. They're a for-profit enterprise, but they create massive impact in the ecosystem. Healthcare is another aspect or a field that needs a lot of attention. And one thing I will say, Charles, is we try and stay away from businesses that require a lot of upfront capex and asset financing, because it just makes it very hard. You cannot use equity capital, which is by far the highest risk, to fund assets or capex. That is the domain and privy of working capital financiers and low-cost debt providers, right? So as an equity holder taking on the most amount of risk, if you're on the cap table and if you got 7 other folks, senior debt, sub debt, mezz debt, convertible debts, it's pretty messy. So we try and stay away from high asset financing requirements.
That would be like manufacturing, or is that an example? Or
yeah, we wouldn't do. It's not that we wouldn't do hardware. If we do hardware, there would have to be a software component to it. So a good example is a company we backed almost 18 months ago. In fact, more than 18 months ago, almost 2 years ago in Nigeria, run by 3 Yale PhDs. It's a company called Orexol, and they have a mobile spectrometer. It's a hardware device that they manufacture that's used to determine fraudulent, fake drugs, medical drugs, right? So someone gives you a batch of, let's say, doxycycline, which is a malaria medication that people use all over the world, right? If you've got a higher percentage of protein or water or a stabilizer versus what the actual amount of the actual medicine, the what's it called, quinone, whatever.
Right.
You can fake a barcode, you can fake a QR code, but you can't fake chemistry.
Right.
So they would actually use mobile spectrometers, so literally passing UV radiation through it. And if the spectrum coming out does not match what's written on the tin, then you've got a problem. And then that data is then sold to pharmacies. Pharmacies pay us a monthly subscription to access quality vetted drugs that are RxSol certified. So that's a great example of a hardware company at first that's actually generating significantly more money from its subscription, aka software. Right. So
right. The data is the problem.
Yeah.
Mm-hmm.
Yeah. So that's
Okay. So let's switch gears a little bit. One of the things that's kind of in the news a lot now is, sort of the global situation with venture funding for tech companies. We sort of all know what that is. It's, there's been that quick pivot from grow at all costs to make money today. That thing that happens when markets hit the brakes. But the narrative in Africa is that Africa hasn't been impacted by this. I'm wondering what your take on that is, whether that's a lagging effect or whether Africa is just different. Could you you have some thoughts on that?
Yeah, listen, I've been asked this question more than anything else in the last 3 months. So here's my take on it. So Africa is still massively underfunded from a VC standpoint, right? Massively. So Africa accounts for about, I've said this so many times before, Africa accounts for about 20% of the world's population, about 7% of the world's GDP, and less than 1% of the world's venture capital. So there's, it's compounded arbitrage, to use a fancy word, right? So there's, $5 to $5.5 billion of venture out of a $650 billion venture industry last year is shocking. So as much as people like myself that are, a big part of the venture industry in Africa are super happy that it's grown by, 2x or 3x, it's still, a drop in the ocean. So if anything, I feel that, I wouldn't say Africa is counter-cyclical, but when you see a global lull in venture, that money is not suddenly disappearing into the ether and just sitting in bank accounts under mattresses. It's going to go into parts of the world where there's the biggest need. And the reality is Africa has the world's youngest population, right? The average African is 18 years old. 18. The average American, I think, the average American is like 39. The average European is like 45. Right? We have the youngest population. We have the fastest growing population. Let's not forget that. We have the population with the fastest increase in internet penetration, by far the fastest increase in smartphones, and the fastest drop in cost of data, right? So at the turn of the century, in the year 2000, there were more mobile phones. There were more smartphones in New York City than the whole of Africa, right? Let's just sit for a second. And 20 years later, in 2020, there are more smartphones in Africa than the whole of the US, right? So in 20 years, there's been this massive transformation. And people forget that we are now increasingly in a consumer-driven world than a producer-driven world. So if consumption is everything, we have to thank Uber and Airbnb and the gig economy for this gradual decentralization of assets and the less of a focus on ownership. People don't want to own things anymore. They want to just use and rent and et cetera, et cetera. So you have the African consumer, 1.4 billion Africans that are consuming a lot more. And ultimately, they become the biggest recipients of innovation in tech. So any innovation that is, and this is interesting, Charles, is because innovation coming out of, and I've seen this as a venture capitalist in Africa, is a lot of European, American, and Asian startups are now saying, hey, where are my next million customers. And they're like, it's not in Europe, it's not in, maybe in Asia, certainly not in the US. And they're increasingly looking at Latin America and sub-Saharan Africa, or just Africa as a whole. And then we're saying, cool, if the consumers are here, why don't we start building things on the continent, right? So you're going to see a big uptick, I feel, in VC activity in Africa, because you're solving real world problems, and the purchasing power of people has really gone up here. So this, the 1.4 billion people in Africa are suddenly a much more lucrative audience from a pure selfish consumer perspective than the 1.4 billion people in China and India.
Right. Well, I was just writing last week about a company called Minka. It's based in Colombia. That it's seeing Africa as its next area for expansion, because they're building products there that they feel kind of solve a similar problem for a similar population in terms of financial inclusion and tech adoption, et cetera. So I think we'll probably see Asian companies and Latin American companies not looking to North America necessarily to expand, but perhaps to Africa, because they're building products for a similar population and a similar set of characteristics, and they're solving similar problems. So that may be something we'll see a bit more of. Shifting gears again a little bit, so kind of you made a case that Africa may be, in a sense, a beneficiary, or certainly not a loser in the current environment for venture funding. But is there a short-term concern with issues like inflation and global recession, et cetera, that affect your companies, and how are you advising your companies to sort of condition themselves for what's coming or what's already here?
Yeah, listen, I'd be lying if I didn't say that there was, or there is, a tightening of the belts, and people are being a bit more cautious about how they're spending money. And this whole idea during the course of last year, where it was grow at all costs and let's not worry about profitability, and we'll build stuff and people will keep buying it. It was, having gone through the 2008 recession myself as an investment banker in New York City for Lehman Brothers, I know what it's like.
You saw it all.
So if there's anyone that knows how to do with this, it's probably myself. But the reality is, there was a little bit of, I wouldn't go down and go as far as Alan Greenspan's irrational exuberance, but there was a little bit of it this past year, where startups were raising valuations at pretty rich multiples. Not just raising money, acquisitions were happening last year in Africa at north of 20 times ARR, annual recurring revenue, which is pretty rich. So I think there's been a pullback on that to more realistic numbers, depending on whether you're a B2B enterprise SaaS company or you're a B2C e-commerce company. Valuation multiples have started to go back or regress to where they should be. Anywhere from 2 times revenue to 10 times revenue. But the reality is, we've been telling a lot of our portfolio companies, make sure that you always, at any given point, have 12 months of runway, at least 12 months of runway, right? And if that means, that doesn't mean you suddenly go out and start laying off staff, because you don't want to lose talent, but you want to make sure that you incentivize staff enough. So maybe, reducing your fat in your team, but incentivizing them with long-term incentives. So a bigger part of their compensation is in ESOPs, or long-term incentives. And people did this quite effectively during COVID. Right. So it's that preserving cash, making sure that you can sign longer contracts if you have B2B business models, offering discounts to your corporate clients for committing to longer-term contracts, especially if you're working with insurers and telcos. Say, hey, let's do a pilot, and you commit to 2 years, and we'll give you lesser, I'll give you 20% off or whatever. So you've got to be innovative in the way you look at contracting with your clients, better terms with your suppliers. So yeah, it is a season to be cautious and prudent. And also from a fundraising perspective, don't raise a ton of money at when valuations are at I wouldn't say historical lows, but at seasonal lows.
I was going to ask are we going to start seeing are a lot of these exuberant raises from last year going to lead to down rounds this year?
Yeah, I mean that is a real threat. Luckily, a lot of pre-Series A raises were done on safes. Mm-hmm. So you'll see a lot more companies not do price rounds, especially in the next I would say the next 2 or 3 quarters. Mm-hmm. The good thing about a safe note or a KISS note or a seed fast, whatever you want to call them, depending on the jurisdiction you're raising in, is you can defer, you can kick the can down the road and do a priced round, sometime in Q1 or Q2 next year, and just raise convertible notes or safes and just modify your cap and make sure you don't raise more than you need. We used to tell our portfolio companies a couple of years ago, raise for 18 to 24 months of runway. But, in a market like this, you'd say, be cautious about how much you raise. I mean, raise for 12 months of runway and prove that you can meet your KPIs. That is sort of the broad call to a lot of our portfolio companies is, if you said you were going to achieve X by the end of this year, do raise just enough money to make sure that you can in fact achieve X, or maybe do 20% more than X, right? Don't worry about having 24 months of runway. Have 12 months of runway. Don't raise too much, because you can always raise more at a much higher valuation once the market gets better. And I mean, in these sorts of markets, traction trumps everything. Right. And what's interesting about markets like this, Charles, is this is also an incredibly good market for M&A. So you can separate the wheat from the chaff, right? So you'll get a lot of good fintechs or good e-commerce companies that have the numbers that can use as an opportunity to say, hey, I can buy, a few other smaller tech startups for pennies in the dollar. And there's no better time to do it than right now. So, I mean, you're going to see a lot of consolidation happening in the tech startup space in Africa in the next sort of 18, 24 months.
Yeah, I was curious about that, because the question I was going to ask, which would probably lead to that answer, was, are there too many of X sector, again, resulting from sort of that modest level of irrational exuberance you described? Too many fintechs, in the sense that, is that going to drive some of the M&A, that there was a bit of an overseeding of a certain category, perhaps?
Yeah, I reckon there was in certain categories. Yes, it was the flavor of the month to be a payments provider in Nigeria, like about 18 months ago, right? Or to do digital unsecured lending in Kenya, or to be a payday lender in South Africa, right? You had this explosion of half a dozen to a dozen startups within a particular niche subsector, and maybe there was it was a bit too much, but you're going to see a gradual. So I mean, so he or she who has the most amount of runway and cash flow will have the opportunity of doing strategic acquisitions. And by the way, a lot of these acquisitions don't need to be cash acquisitions. A lot of them will be stock. And although stock is not going to pay your school fees, literally, a smart long-term founder would prioritize, let's say a 50% cash, 50% stock acquisition over 100% cash acquisition any day, right? I mean, if you look at
giving yourself some upside there, potentially.
Yeah, and I mean, the thing about, I'm sure you've heard this term before, horizontal M&A versus vertical M&A. Horizontal M&A is when a larger tech startup buys a smaller tech startup. A good example of that was Stripe's acquisition of Paystack, right? When Stripe bought Paystack for $200 million about 2 years ago, it was, from what I recall, it was a 50% stock, 50% cash acquisition. And the market value of Paystack went up significantly in the following 18 months. So in effect, it was significantly more than a $200 million acquisition, right? So
Right.
if I would, as a founder of a small early stage startup, irrespective of sector, I'd prioritize being acquired by a much more prominent later stage startup, a Series C or a Series D startup,
Right.
versus a telco or a bank buying me just because they want my customers or my tech.
So I want to wrap up with just kind of a lightning round of quick answers to a few questions, if that works for you. So what sectors next 18 months are you most excited about?
To listen to the full episode, consider becoming a subscriber to Big5D podcast on Substack. You can find it at ctlaughlin.substack.com. That's ctlaughlin.substack.com. Thank you.